For those of you that are joining a little bit early, welcome. We've got about 3 minutes till the top of the hour. Welcome, everyone. We've got about 1 more minute until the top of the hour, and then we're going to get started. All right, we've reached the top of the hour. Welcome to everyone that has joined this webinar today. We're excited to be with you here to talk about HELOCs and how they've become a game changer for mortgage lenders. We have a great panelist group here today and a lot of great discussion to be had. So we are going to get started right on time. Welcome to all of the guests. Welcome to all of our panelists. We are ready to get started. Before we do, a couple of housekeeping items. You guys will notice that the presentation is being recorded as you join, so that will be available to your colleagues if they're not able to attend today's live session. All guests will be muted, so if you have any questions, feel free to put those into the chat function, and we will be answering your questions live during the presentation. We have Alexander Nichols and Jackie Langton to do so. I will go ahead and jump into our panelists. We're really excited to introduce Mike Cagney, the CEO and co-founder of Figure today. We have Barry Habib, CEO and founder of MBS Highway. We've got Jackie Fromer, head of lending here at Figure. We've got Anthony Stratus, Senior Director of Lending Partnerships at Figure. And we have Phil Shoemaker, CEO at The Loan Store. Welcome to all of our panelists. We're glad to have you here today. So as a quick overview of our agenda, we're going to just do a top line look at where we are today from Figure's perspective, and then we're going to hear from Barry Habib on industry trends, mortgage industry, and home equity lending. We're going to dive into the HELOC product, why it matters for you and your customers, and we will even hear about some of the successes from our partners so far, and then we'll conclude with a Q&A from Phil. So looking forward to all of that. So with that, I'm going to actually pass it over to Mike to take us through where we are at Figure today.
Thanks, Kat. So I think when we think about what we're doing on the HELOC side, I always go back to the genesis of the HELOC itself and how we thought about the product. And it really goes all the way back to when we were at SoFi doing personal loans, and 80% of our borrowers were prime borrowers. Most of them owned a home, and the average CLTV was around 65%. And no one could figure out why they were taking personal loans when they could take HELOCs. And the answer was relatively straightforward. It was speed and efficiency, that people didn't want to spend 45 days going through an application process and all the burden that comes with that. They wanted it to be a simple online experience. And so we set out to build a HELOC experience that mimicked what was happening on the personal loan side. So a way that someone could very efficiently go through, determine property value, title, income, without having to go through, excuse me, a traditional underwriter and processor process. And we've gotten that down to a structure where we can generally approve someone within 5 minutes. It still takes us 3 days to fund because of the rescission or the required rescission related to that. But it's an extremely efficient process, and it's very much oriented towards not the way we thought about HELOCs historically as sort of this, rainy day line of credit, but actually using the money now. So home improvement, education financing, debt consolidation. I'd say about half of the loans that we originate today are for home improvement. The other half fall into primarily the latter two buckets, but different applications and different use cases there as well. We're originating today both direct to consumer and through the business to consumer channel, the wholesale channels, about 400 million a month. And we expect to continue to ramp that up because of some of the benefits that we're getting on the macro side. In particular, we're seeing a significant contraction of bank credit. So we're not seeing the banks aggressive, especially in the high FICO, low CLTV market segment where they have been historically. They've really backed off of that. And given us a lot of ability to lean in and originate there. But you've got this combination of bank credit contraction, relatively high rates, meaning that people's first liens, often are in a 3 handle and they don't want to refi and lose that on a cash out refi. And a capital market that's starting to open up and understand HELOC. And in particular, as it relates to the capital market, we're becoming a programmatic securitization issuer. So we're issuing AAA rated securities backed by our underlying HELOCs, coming to market every 8 weeks or so with securitizations. And we expect to continue that to really raise awareness and bring the capital markets in to understand the product and be willing to allocate capital to it. But we've also worked on building a set of forward flow agreements, well north of $1 billion in flow agreement commitments from capital partners, so that inevitably, when those wholesale capital markets shut down, we still have the ability to provide takeout for loans, and that provides continuous and uninterrupted ability for you to originate those loans. So the net of this is we think we built a process that's extremely efficient. It's very customer friendly. It's very loan officer friendly. It's a very expedient process. And we think that we created a capital market infrastructure on the back end that, rain or shine, provides takeout. So uninterrupted continuity of your ability to originate those loans and deliver them into us. And super excited about what we can do over the next 12 to 24 months, especially with, continued elevated rates, both on the treasury side and the first lien mortgage side. Huge amount of equity that people have in their homes that they'd like to be able to tap for a whole host of reasons, and less competition from the banks in terms of leaning in and really, taking loans for their own portfolio. So very excited about where we are, very excited with the partners that we've had, and as we built the product up, and excited to hear the webinar today and get everyone's questions and responses at the end.
Great. I'll let you introduce Barry as well.
I'm introducing Barry. I think everybody knows Barry. So my introduction will fall. Very obviously a huge amount of experience in the space. Is going to spend the next 30 minutes with us, talking about the mortgage space and the HELOC space in particular, and how to approach it from a sales standpoint. So Barry, I'll hand it over to you.
Thanks so much. I do appreciate that. It's a wonderful honor to be here with all of you. Thank you for so many of you joining us. I know that your time is valuable, so we're going to get right to it. I'm going to share my screen and we're going to go over some slides together. But first, let me tell you, listen, I know that the environment right now is potentially a little more challenging. It potentially is a little bit scary. So there's nothing wrong with being a little bit worried or fearful. But what I want you to do is I want you to just take that fear, and instead of being the deer in the headlights where, I don't know what to do, use that fear to take action. Clearly HELOCs are an avenue that you definitely should be considering. What I'm going to go through with you now is a quick market update and then some ideas. Many of you might know that I originated transactions. I've been in this business for a very long time, more than I want to admit, so maybe the Botox and hair color covers up some of those years, but 37 years in the industry and over 20 of them as an originator or owner of a business with originators. That was a broker business. So I have a lot of understanding for what you may be going through, a lot of empathy. And, I feel that I'm one of you. And believe me when I tell you, in the 37 years of experience, there have been markets like this where things have been worse than this, and certainly times that are better than this. And so what I'd like to share with you today is tactically, what would I do if I were originating loans right now, and share that with you because the things that you could be doing, that you should be doing, and taking action right now is very important. Because let's face it, if you're not as busy as you like to be, you have time, and everything I'm going to explain to you to do is easy to do. But some people just would rather complain and bitch rather than take action. So I suggest to you that you take action on a lot of these ideas. So first of all, let's get started, because I think that what we need to do to have success in today's market is understand things. So look, I don't mind if somebody takes a quick screenshot or something like that as to what we go through, but you can't like record this or go post the whole thing. So that wouldn't be right, because it's proprietary. Now, to underscore some of the negativity that's out there, I don't know if you saw the article in American Banker that said, hey, is it time to quit mortgage and real estate? They say, you know what? Volume on purchases is down so much. Volume on refinances are down so much. And they say, is it time to quit either real estate or mortgages? And I will emphatically tell you, no, it is not time to quit. So how much business is out there this year? So here's what I want you to think about. I want you to think about there's 4.3 million existing homes that will be sold, another 700,000 in new home sales. What does that tell you? That there's 5 million real estate transactions. Now, not all of them have a mortgage. When you take a look at those that will have a mortgage, that means it's going to be 3.7 million real estate sales that will have a mortgage, and 1.3 million refinances. So that's 5 million transactions. So when you start talking about, if you want to be in the top 15% of income earners in the United States, you need an income of about $100,000 a year. What does that mean you need to do in the mortgage industry? Roughly, it depends on your market, but roughly 2 loans a month. So you don't need the other, 4,999,000 and whatever. You need to worry about 2 loans a month. You want to make $200,000 a year, you got to do 4 loans a month, 1 loan a week. What can we do right now to get that transaction? So here's what we need to accomplish very quickly on this call. You need to make more income right now. How are you going to do that? Well, HELOCs certainly is one of them. I'm going to show you some other ways to do that too. But you can gain market share with realtors. They have a lot of challenges right now. Realtors are having a very tough time. There's 1.5 million realtors, and those ranks are going to be severely cut, because those real estate agents that are ill-equipped to handle the client's questions or concerns are not going to be able to have an easy time here. Here's where you can really help, because the challenges that they face are buyers' reluctance to give up a low rate that they have and move up. You've heard it over and over and over again. That would create listings, that would create sales. Then you have customers waiting for rates to come down. Now, yes, rates are going to come down, but is it a good idea to wait for that? Or is this truly an opportunity and a friend to a buyer that rates are higher? We need to be able to explain that. Then right now, 33% and rising. The real estate market is so hot, 33% and rising are paying over asking price. Multiple offers, but 33% paying over asking price. And then there's client fears of a housing bubble. So let's get to work. So first of all, let's understand interest rates and where they're going. Now, the bottom line here that you see on the left in pink, that's the rate of inflation. And the top line on the left in blue, that's a 30-year fixed rate mortgage. Now, the fundamentals forever is that mortgage rates follow the direction of inflation. So as inflation rises, mortgage rates rise. Inflation comes down, mortgage rates come down. Inflation goes sideways, mortgage rates go sideways. Even this little blip is followed by a blip up in inflation. Inflation is followed by mortgage rates moving higher. But this relationship was broken after the recession, which is the shaded area here, and then pandemic, which occurred in January and March of 2020. You got a recession followed 2 months later by a pandemic, double whammy. The government comes in and they start buying loans and fixing essentially the mortgage market at roughly, as you can see here, 3%. They did a pretty good job, a little above, a little below 3%, but that's where the mortgage market was. Now, that was okay initially because inflation was so darn low. But then inflation started to take off. The Fed ignored it, and they should have stopped here. They could have stopped here. That would have caused So much less pain that we're going through here. We're headed for a recession. You've got a lot of inflation that ensued. The Fed's trying to bust the jobs market. The Fed is trying to stop inflation because they let it get out of control. And if they could have stopped here, it would have been a different story. But no, they kept quantitative easing going for much longer than it should have, and they kept interest rates at zero much longer than it should have, and inflation really started to take off. Now, notice that once the Fed stopped fixing things and fixing the market and they let the market trade freely, what did the market do? Mortgage rates did what they always do. Fundamentally, they followed inflation higher. Even last spring, when inflation took a little bit of a decline, so did mortgage rates. But then in the summer, inflation took off, and with it, so did mortgage rates in 2022. But now, since mid-November of 2022, inflation, as we have anticipated, has started to come down. Mortgage rates first started along that path, but notice the disconnect here. Now, we thought, and we were very, very public about it, we thought that the housing market would be very, very strong, while almost everyone else thought there'd be a crash. We nailed that one. We felt that inflation would start to come down. We nailed that one too. But we thought that interest rates on mortgages as of around May 10th would begin to come down, not the destination, but the beginning. That really hasn't happened yet. So we got that one incorrect. But why did we get it incorrect? Why do we have this disconnect? Because just like here, when you had exceptional buying by the Fed, you've had exceptional selling. What's causing that? Well, I'll explain it to you. It's the banking system that we have. So the banking system that we have has money that's in deposits, and you could see the yellow line, that's been where money's in deposits, and the bottom line is where we have money in money market funds. Now, money market funds a year ago in 2022 were paying very little. They were paying about the same thing you were getting in a deposit, a fraction of 1%. But now, because the Fed has raised rates so dramatically, people are taking notice that you can get about 5% in the money market and very little in a bank deposit. They still want to put money in bank deposits because it's convenient. You can write checks against it. It's just more of a convenience. You don't have to tie it up for a period of time. But look at what has happened. This drain of the deposits and the flow into money markets has been sensational. It's been unbelievable and unprecedented. This is all because of what the Fed's done. And then the banking crisis put additional emphasis on it. This all happened about the time of the banking crisis in March. The FDIC seized assets of the failed institutions and started putting them up for sale in May. Just when we thought mortgage rates were going to come down, what did you have? Selling that was happening in May. So counteracting the benefit we were getting from inflation. Now, fortunately, this decline in deposits finally is stabilizing. So you're starting to see a little bit of stabilization here. And that is good news, because now that means that banks won't have to sell assets like mortgage-backed securities to make up for fleeing deposits, because they have to reimburse those depositors. They can't take it out of the car loan they've given, the HELOC they've given, the business loan they've given. That money's tied up. So the only way the banks can reimburse depositors, because they only have 10% of their money initially, that's our fractional banking system, is when there's large amounts of depositors pulling money out, they have to sell assets that they can sell. What are they? Mortgage-backed securities and treasuries. And that's why you've had this bump up in rates. Now, inflation is the fundamental driver here, and inflation is coming down. And a big part of inflation is shelter costs. Shelter is rents, owner's equivalent rent. And as you can see in real time, rents are coming down. But the way the Fed looks at it, they look at it based upon the year-over-year numbers. Now, the year-over-year numbers averages the past year. That's why when the Fed looks at it, the Fed says, oh, shelter costs are 8% a year, but in real time, new rents are going up at 1% a year. This will eventually catch up. And it's one of the reasons we've had in the past why there was such a problem. See, the Fed should have stopped right here from keeping rates at zero and quantitative easing. We would not have the problems we have today, but the Fed was looking here. They were looking at the rear view mirror. They were saying, oh, well, inflation is very low. 43% of it driven by rents, which are only going up for the past 12 months. When you take a look here, what's rents going up in the past 12 months? Well, they're going up 1.5% a year. That's very, very low. But in real time, they were going up as high at the time as 15%, but the Fed paid no attention. It's like driving down the highway, but looking only in the rearview mirror. This is why we have boom and bust cycles. The Fed is not very good at these lags. Remember, our Fed chair is not an economist. Our Fed chair, Jerome Powell, is a lawyer. Now, I'm sure all of us are very smart people, but if we're not a lawyer, we're probably not the best person representing you in a terrible legal issue, right? You want a lawyer to do that. Well, in an economic issue, is a lawyer the best person to be driving the most important economy in the world. No, he's going to drive us right into a recession because he's raised rates too fast, too far. And we've had 14 months of leading economic indicators showing and pointing to a recession. That is a very reliable indicator. There are several others, including the inverted yield curve and many, many others. Don't believe the job numbers. The job numbers use models that are very outdated. If you use the more real-time indicators, they're all showing much more weakness in the job market. Now, what happens when we get into a recession? Probably sometime this summer, this fall, we get into a recession. If you look at history, every time we get into a recession, mortgage rates on 30-year fixed rate mortgages drop 1%, 1.5%, 2%, 5%, 4%. We're going to see mortgage rates drop. And that will be a good thing for us. So we have that to look forward to. Lower inflation, the fundamentals will return, mortgage rates will decline. So this is something good that we have to look forward to, because remember, every loan that has been done in the past year is now going to be a candidate for a refinance. And there's other reasons to refinance. There's cash out refinances. Why is that so important? Let's take a look at our personal savings rate in the United States. Now, this is the recession and pandemic period. Pre-pandemic and recession, notice we had about a 10% savings rate. Now, we had a double whammy. We got a recession. We got a pandemic. We have to shut down the economy. Here's a big stimulus check from the government. Boom, where does it go? In the bank. Why? You can't spend it. How come you can't spend it? Well, I can't spend this money because I've got no place to go. The economy's shut down. Well, what did I do with that money? Notice what was happening in the meanwhile. We had jacked up our credit cards to all-time highs. So I pulled the money out of my bank and paid down my credit cards. No worries. You got another stimmy coming here. And now the economy's open. I got to wear a mask, but I can go shopping and spend that money. That feels pretty good. And that was spent even faster. No worries. I got another stimmy right behind it. And that was spent at a bigger amount, even faster than that. But now, with the stimmies gone and feeling like I want to keep spending because I like this, how did we do it? We drained our savings account, which has gone from 10% to less than 5%. And we've jacked up our credit cards to not just the all-time high, but way in excess of the all-time high. But it's worse. A year ago, you're paying 14% on your credit card balances. Now you're paying 22%. Car loans, the average car payment has doubled in the past 3 years. And that's really being jaded by the fact that now we're stretching it out towards 6-year terms. So it's really worse than that. Okay. So people have a lot of debt. What can we do? We can use the equity in their home. The average equity in the home is $231,000 because the average loan to value in the United States is 42%. Black Knight says the amount of cash out you could pull out on average is $185,000 you could pull out in cash out on average. Also means available for home equity lines of credit. Now, people say, oh, I don't want to give up my first mortgage because I've got this 3% rate. Well, first of all, only 23% of people have a mortgage at 3% or less. The bulk of people have a rate between 3 or 4. It represents about 60% of individuals are within that range. So a lot of people have that rate. Let's just say even a 3% rate. You have a 3% rate on your mortgage, but you're not paying 3%. What are you paying on your credit cards, on your car loans? What are you paying on your personal loans? What is it? When you blend the rate, you'd be surprised. It'll be above 4, above 5, above 6. So based upon that, now what we could talk to people about is things that they can do to be less mindful of keeping that 3% or 3.5% or 4% rate, because if you blend it together, they're paying much higher. So let's talk about how we can help our real estate agents right now. What can we do? Well, for a realtor, the biggest problem they have is I don't want to give up my 3% rate to go to 6 3/4. So let's take a real case study, true example here. And there's tons and tons that we see. Original purchase a few years back was $500 with a $400,000 loan. That value's gone up and the remaining loan balance is lower. They've got equity in the home. So look, if you sold your home, what do people think about doing? I'm going to sell my home for $695. I pay off the $343. I pay the $35,000 in cost to sell. I've got $317,000. What do they do with that $317,000? They use it to put down on the new home plus their closing costs. So my closing cost on the new home might be $12,000. I'm going to take my $305,000, put it as a down payment. My dream home that I need the space. I want the yard. I want that office for myself, whatever it is that I want. People want to make this upward move. They want to do this. And their dream home is now $850,000. So they're going to take the $305,000 down payment, sale from their home that they get, the cash, put it as the down payment here after the closing costs, and they take out a mortgage of $545,000. But you know what? When they were paying 3%, on $400,000, that was a lot cheaper than 6 3/4 on $545,000. In fact, the difference is $2,572. And they're saying, whoa, that's a big difference. And plus I got to give up that 3% rate. But here's the thing. What if the borrower has debt? And most people do. Well, if the borrower has debt, here's what you do. Instead of taking all that money and putting it down on the new house, which would give you a 64 LTV, and that's how people buy the home. Why don't you put less money down? Take some of that $305,000 in equity that you have and wipe out your debts and take out a bigger mortgage. See, if you did that, guess what happens? You have no debts, you're debt free, you bring your LTV to a 76, and the difference between what you're paying right now on your mortgage and all your debts to what you'd be paying now on your mortgage with no debts is just $286 a month. Now, depending on the debts they have, I've seen this change to where it's cheaper to get into the new home. You have to show this to real estate agents because your realtors need you to help them right now. And even if you have the idea, they'll be saying, wow, this is somebody who's proactive, who's got an idea, who's got a solution. Will this help everybody? Of course not. If somebody doesn't have any debts, this does not work. Or if they have very little debts, it does not work. But you'd be shocked at how many people have so much debt, and this will work for them and get them the home of their dreams. Okay, so what about the second problem? Hey, I want to wait. Barry, you just told me rates are coming down. So if they come down 1%, shouldn't I wait? Here's another real case study that turned into a loan. These are sent to us by our subscribers. The rate went at the time was 6.5, went to 5, and if they waited 6 months for rates to go to 5.5, this was in Palm Beach, and the appreciation forecast, which we have for every zip code, is only 2% forecasted over the next 6 months and 3% forecasted over the next year. So if they were to do this loan today at 6.5% with 1 point versus waiting and paying 5.5% with 1.6 months from now, assuming rates come down, is it wise to do? Well, the payment would be based on a little higher mortgage because the property would appreciate 2%. So you need an $800,000 mortgage today to keep an 80 LTV. You need an 816 mortgage, so it's a little more expensive, but the rate's a lot cheaper. The monthly payment difference is $400 a month. Man, shouldn't I wait the 6 months and save $400 a month? That makes a lot of sense, right? It's a lot of money to save. Maybe I'll wait the 6 months. But it's just 2% appreciation. You're going to lose $20,000 on that home. And what about the amortization? That's $4,400. So bottom line, you'd lose $25,000 between appreciation and amortization. Now, you can always refinance and get that 5.5% rate. So that's $3,000 cost to refinance. Let's deduct that. And the payment differential for 6 months, let's deduct that. Buy the home now. You'd come up ahead by $20,000, $19,000. Team, you got to show this to your realtors because they need help. You see, what you got to explain is buying the home today is better than waiting. Buying the home with a higher rate is better than waiting with a lower rate because there's very little inventory now. Imagine what happens if rates drop, and they will drop. And then you have all these new buyers coming into the market, less homes to choose from, and more bid over ask. And bid over ask is already heating up. Right now, 33% of homes in Rising are bid over asking price. How do you help that realtor? How do you help that customer? Look, real example, another real case study. The current asking price and value is $459. The only way they're going to get is to pay $10,000 above that and pay $469 for a home that's worth $459. Now, in the absence of logic, this is just a emotional decision and a guessing game. You step in as the advisor and you explain to that realtor, you explain to that customer that here's what we need to do. The question you have to ask is, how long will it take for the value of this home to appreciate, to break even? And then what happens after that? Fortunately, we have that data for every single zip code. So how long will it take? In this particular zip code, it would take 5 months. So maybe it takes you a month or two to close. So that means after you close, you got to wait 3 months, 4 months before you break even. That's not so bad. And this is a market that's only appreciating at 3.82% for the year. What's the forecast for the next 5 years? Well, it's 3.66% is the forecast annual appreciation for the next 5 years. What does that mean you make on the home in the next 5 years? $90,000. Wow. And by the way, that's a 3.66%. How does that compare to history? Well, in this zip code for the last 63 years, they've averaged very close to that at roughly 3.5%. So you could see that this has a very high accuracy level. And this is something that maybe that client might just say, hey, you know what? I don't want to spend $10,000 more, but I wouldn't mind spending $10,000 more if I only have to wait 3 months after I close to break even, 5 months from today to break even, and I'm going to make $90,000 in the next 5 years. That seems like a good deal to me. The team, this is exactly what you have to do with your clients to show them, get your realtors to show them. Okay, Barry, what about my realtor who's worried that there's a housing bubble, or their client that asks them, what's the realtor going to say? Oh, don't worry, the market's good. That's not going to fly. Look, you think there's a housing bubble? In 2007, during that housing bubble, there were 4 million units for sale. Today, there's 1 million units for sale, 3 million less for sale, and our population's grown by 30 million. And then what about inventory? Well, I told you there's 1,080,000, but of that inventory, do you know that almost 45% of those are already under contract because the market's so hot. So we've only got 582,000 active listings. And this is in an environment where you have less than 50% of what we've been accustomed to in 2017, 2018, 2019. So it was starved for inventory. People worry that prices went up during this period of time. Housing has been so strong. 73 years of the last 81 prices have gone up. 7 years they went down, 2 of them very slightly, and 1 of them was break even. So why do people worry about this? They say, well, it's got to be a crash because prices went up right here. They went up 10%, then 19%, then last year in 2022, 6%. Remember, everybody thought it was going to be a crash last year. No, not a crash. Prices went up 6%. Okay, so does that mean it has to crash? Well, let's look at history. This period of time, this 6-year period, prices went up 118%. And if you thought they were going to come down, you'd have to wait a long time. You'd wait 43 years before they just took a break and then went up another 14 years in a row. This period of time in between, it went up another 93%. So imagine if you passed up on buying a home because you thought there was going to be a crash. Thing of it is that everybody worries about this period of time. They ignore all this and they just worry about this. But this period of time had some anomalies. 1, inventory, as I explained to you. 2, demographics. Look at all the homes built during that time and the demand. These were new households being formed. Today, many more households being formed, not enough homes being built. Plus lending standards. What was the lending standard back then? Fog up a mirror. Do you have a pulse? You're approved. No income, no asset, no job, 580 FICO score, no down payment. We don't have that today. Now, we've already seen the turn this year. Now, it's true from June of last year to December, we saw moderate price declines, maybe 2.5%, 3% price declines. But on a year-over-year basis, that's starting to turn in our favor. As you could see, 2022, prices went up 6%. 2023, they're going to go up again. Look at the turn. January was a transition month, but every indicator up in February, every indicator not only up, but accelerating in March. Every indicator so far is up in April, and tomorrow we get Case-Shiller and FHFA. So we'll see that. What was the last time prices bottomed? And they're bottoming now already. Last time it bottomed, and the next year they went up 8%, and that was with 2.4 million units in inventory. So we're seeing that. Now, people will make a big deal of the median home price. Oh, the median home price is going down. That's because they don't understand math. So here we go. Let's understand math and understand the difference between price appreciation and median home price, because it's disgusting what's out there. And these idiots are talking about, oh, prices are coming down. They're talking about median home price. Let's understand it. 2022, let's say 5 homes were sold. What's the median? The median is the price in the middle. It is not the average. It's the middle price. Okay. Lowest to highest. The middle price is the median. That's what the definition is. So the median is 270. Now you had 2022, you had 6% appreciation. So if we had 6% appreciation, all of these values, every one of them went up. So they are worth more. But in 2023, if only 3 homes sold and the higher end doesn't sell, and there's a mix of homes more on the lower end that sells, what's the median price? The median is 238 of the 3 homes that sold. So what's the bottom line here? Well, the median price went down 12%. So people say, oh, the median price is down. But appreciation, the value of the homes is up. See, this is something you really have to explain to your clients. Do not listen to median home price. It's because the people in the media want to sensationalize it. They want to be negative. Last year, we predicted 5.5% appreciation, pretty close to a bullseye. This year, with all the things we've talked to you about and rents no picnic, 5.8% appreciation, I think we're going to be pretty darn close. Now, some of the things you have to do to motivate your buyers, explain to them and show them why buying is much better than renting. We have a great tool for that. Many of you use it. I know that. But you have to explain to them that part of their payment is interest, which is tax deductible. Not even counting that, though. What's wonderful about it is principal. It's a forced savings account. It amounts to $60,000 in an example like this of buying or renting a $500,000 home. And the rents go up even at a modest 4%. Probably in the first few years, you will notice that that rent becomes more expensive than buying. And then appreciation. What people don't understand is just 4% appreciation can be an enormous sum of money. Yes, it's true. Maybe in the first year, if you bought and sold in the first year, you might lose money. But typically speaking, 2 years or longer, you will make a ton more money. Show this to your client. Look, if you want to build net worth, Kiplinger did a study. They said you want to be in the top 1% in the United States, you need $10.8 million. Top 2%, $2.5 million. Top 5%, $1 million. If you want to be in the top tier, the top 10%, you need $800,000. If you want to be in the top half, you need $500,000 in net worth. But the same study showed, where does this money come from? On average, 2/3 of all net worth come from, you guessed it, home equity. You can't get rich being a renter. You can't get rich being a renter. And speaking of net worth, the average homeowner's net worth is 40x, 40 times a renter. You want to help people? Show them the opportunity to buy a home. And do you have something where you can go to your realtors and say, hey, let me help you. Next time you go on a listing, let me give you an AVM. See the whole neighborhood. You could bring this as your proposal of what you think the listing price should be based upon facts. Let me pull all the comps for you in an interactive map, do all the work for you, along with a neighborhood report that shows you all the trends there. This is how I would do business. I'd bring them a real estate report card and show them that real estate report card shows them everything they want to know. What's historical, forecasted appreciation, how much you're going to make on this home, what's the rental situation, what's the demographics, what's the inventory look like, how many households are being formed, and how many are being built to show the future. What is the income situation? What's the job picture? What's the affordability? What's the unemployment rate? These are the things I'd be co-branding with my realtor right now. Look, in the great book, The Art of War by Sun Tzu, every battle's won or lost before it's ever fought. Are you going to see a realtor and wanting to do business by giving them a bagel? Or are you going there and saying, hey, let me show you how I would help other real estate agents like you go to a listing and bring these pieces, how they could market on social media, what they should put at every open house, and most importantly, what every prospective buyer should see to see the opportunity. That's what they should do. You want to compare loans? Do it professionally, where you could show them all the differences between the loan products and then give them more. Show them how much they're going to make on this home. Show them the differences between different types of loans or down payments or MI choices, at what point in time the crossover where one would be better than the other, and narrate it for them with a video. And what you could do is you could use this. It creates your own Zoom is what it does. So you don't need a Zoom, and you could send personalized video messages. This is what the loan originator of today needs to do. Thanks to this call. If you wanted to get on MBS Highway, we have that for you. Just email Diana at MBS Highway and save 40% on MBS Highway. I know that money's tight today, but what does it cost to lose a deal? Look, I showed you the story in American Banker. And the story in American Banker essentially said that is it time, or asked, is it time to quit mortgage and real estate? And all their numbers were true. There's one thing I left out. The article was written in 2014. Yeah, very similar situation to what we have today. If you quit in 2014, you missed the best 8 years in our industry. Now, I'm not going to tell you that the next 8 years will be the same. Maybe it'll be worse. Maybe it'll be better. I don't know. But I do know this. I know things are going to get better. I know that if you quit now, or if you become less engaged now, you're going to miss an opportunity. Because right now, if you do the things that we just talked about today, you could put yourself in a place where you can gain market share. You can make more money today. You can help more real estate agents today. I put a lot of stuff on this on Instagram. And if you wanted to follow me on Instagram, you're more than welcome to take it, swipe it, use it, send it to your clients, send it to your realtors, copy it and use it yourself. But you're more than welcome to do that. It's all about the opportunity. Heck, I wrote a book about it. You helped make it a bestseller called Money in the Streets. And team, I want to thank you so much. I think we came in exactly 30 minutes. You can let me know if you have any questions.
Thanks so much, Barry. We appreciate it. And thank you very much for your time. We are going to jump back into the presentation here, switching gears, and let me know when you can see my screen. I think it's up for you, but we're going to switch gears here and talk about Figure's home equity lending offerings. I am going to pass it over to Jackie Frommer, our head of lending here at Figure.
Thank you so much, Kat, and thank you, Barry. Some terrific insight in terms of how we can help sell new homes to our customers. So very much appreciate all the attention that you gave to that topic, and certainly something that is something that I think all of our lending officers on the call will take back with them. We want to spend a little bit of time here talking about our home equity product. And as Barry mentioned, 2/3 of people's wealth is actually in the home equity that they have today in their homes. We designed, and Mike mentioned this, our home equity product about 5 years ago. And it, quite honestly, sort of muddled along for the first 3 years, just sort of given where mortgage rates were and where home price appreciation was. But in the last 2 years, we have seen a tremendous uptick in just the importance of people being able to tap their home equity. As Barry mentioned, there is a tremendous rationale for people to buy new homes, and hopefully you all are having tremendous success in terms of being able to sell that and position that to your customers. But we also realize that with inventory tight and with the aging population, there are a number of people that may not want to sell their homes, and we want to give you the opportunity to be able to actually position another product to your customer alongside sort of the traditional purchase mortgage product and cash out refi product that you usually talk to customers about. We were very lucky with our product because we've been fine tuning it and honing it over the last couple of years. And today, given where mortgage rates are, given where home price appreciation is, and given where inventory is, which is at historically low levels, the home equity product is really a product that people can use to take advantage of the home equity that they've built and be able to finance purchases that they have at much less expensive rates than they have through some traditional products. So we're going to jump into a little bit about our home equity product on the next slide. So one of the things that I don't think Mike mentioned when he kicked off was that we've designed our product initially to go direct to consumers. We always had partnerships and LOs in mind, but we thought that the best way to approach coming up with a product that ultimately you all could use would be to design it first, test it first on our customers, make sure that it was a saleable product, both from a consumer standpoint as well as from an investor standpoint, and then continuously work to improve it. And so we've taken the product that we offer direct to consumers and we've tailored it to be an offering that lending officers and other partners can use for their customers. And we continue to refine it with our own customers every day to make sure that we're offering you a product that really resonates for the current environment with your customers. And so it's really designed by us, but for you. And you'll see when we go through some of the materials and we have a video, just how the product works and how you can use it in terms of positioning your customers' home equity and the advantages that it can give them in terms of tapping their financing needs. Some of the unique things about our product, and Mike mentioned this at the beginning of the call, is that it's fully automated and we really designed it for speed. So if it's 5 minutes to approval and it's can be as little as a couple of days to fund, but we have a 3-day rescission period that we need to build into the product. So typically it's about 5 days to fund. And the speed is super important because it can compete with other typical financing needs for customers. So most of our customers use it for home renovations, but because it's so fast, you can actually use it like you would use a personal loan, potentially like you might use a credit card. Like you might use other sources of financing for things away from home ownership and home renovation in your day-to-day lives. So speed is really what sets it apart. We also have proprietary technology that we've honed over the last 5 years. And so our product is fully digital, meaning that a customer can go from start to finish without having to ever talk to a client service associate. We have an AVM waterfall, which basically allows the product to use an AVM instead of a traditional appraisal to demonstrate the value of the home. We use digital lien matching and automated income verification using Plaid and other sources of income to enable customers to never have to submit a piece of paper if they're willing to verify all their income digitally. And we have online notaries that are figure employees that are there for states where you can use an online notary to have a remote closing. And so the technology really allows a customer to go straight through, which is how we can fund so fast. We do have customer support. So for folks who do want to talk to people or for things that sometimes need to happen offline, we have dedicated people that will be there to service your clients. So we know that not everybody is online savvy. And we also know that sometimes there are exceptions to things that come up in terms of additional information that we need. And so we do have dedicated customer support that can help folks with that. Our product is a standalone product. It's fixed rate. As Mike mentioned earlier, we are a full draw product up front, and we do that because most of our customers are not using this as a rainy day fund. They're actually using it because they have a purpose in mind. And that really helps with the credit quality of our portfolio because the people that are drawing it based on the credit that they have today, not on a future need that they might have. But it is a loan that if you do pay it down, you can redraw. And we have various redraw periods depending on the length of your loan. So it is a HELOC in terms of its ability to both pay down and redraw over time when customers might need an additional source of funds for something in the future. And we're available in 44 states. We are working to be available in all states and hope to be so shortly, but we're pretty much available in all the large states. And because of our speed and because of our process, we really are delighting customers with our customer experience. So you can see here we have one Trustpilot review, but we are rated excellent on Trustpilot, and that's because For customers who can verify digitally and can go through the process quickly, it's like no other HELOC they've ever seen. For those of you who've gone through the HELOC process with a traditional product, it can take 6 weeks, 8 weeks, 3 months potentially, and feels much more like a typical mortgage process. This really feels like a personal loan product. And so it really wows our customers that they can go through and get significant amount of money with very little information supplied by them. And if you can see those terms on the right there, we lend up to 400,000. We have various terms. We actually do allow for investment properties, which is something unique in the HELOC space. And our CLTVs go up to 85%, and our minimum FICO, depending on your CLTV, is 620. So the product is truly a product that can be used by lots of your customers, and is really a great way for them to be able to tap the equity in their home to do things that normally would cost them a lot more if they were using traditional financing sources. What I wanted to do next is show you all a quick video. This is the customer experience. We'll talk a little bit more about what the LO experience would be in terms of your interaction with the customer, but we thought it would be helpful to just show you how quick and easy and seamless the product is for customers. So I'm going to have Kat take the video away. Thank you, Kat. So it really is that easy, and it's really that quick. So we do have a full demo that's on our website, but hopefully that gives you a glimpse into how fast it can be for a customer. And like I said, we've got a lot of proprietary technology underneath this that we've honed over the last 5 years to make it as fast, as efficient as it can be. And we have done a number of securitizations and have ratings from the rating agencies, which really have come from both the complexity that goes into the algorithms that we have that underlie this application, which looks relatively straightforward, but it's many, many years and lots of sort of data and analytics behind it to get the rating agencies and investors and capital markets comfortable with the loans. And the performance on our portfolios really has been exceptional based on all of the fine tuning that we've done of those algorithms over time. So if you can just maybe flip to the next slide, Kat. Oops, there you go. So as I mentioned, and I'm not going to spend a ton of time on this slide, but it's really the speed that makes this product very different from a typical home equity. And so there may be situations where your customers can take the time and would rather have something that's more traditional. This product, we've really seen it positioned to customers in a way that allows them to really sort of take advantage of things that they want to look at or react to very quickly. And also that are things that they might have traditionally financed some other way. And because it's so simple and easy and requires really little effort on their part and can be approved so quickly, and the rates are better than most of the traditional products, we're seeing customers use this in a variety of ways. So home improvement, of course, and debt consolidation are the typical ways that people have in the past used home equity. But we're really seeing more and more that people are using this for sort of non-traditional home equity financing routes, but things that they would typically use different products for. So we're seeing folks use it for medical expenses, education. So, there's obviously a lot of things that are happening in the student loan space, but for parents who want to help their kids finance education, home equity is a great option. People are using it obviously for retirement needs, especially for folks that want to age in place. It's a great way to tap the equity that's probably been built up over many years to pay for expenses that they might need to pay for during retirement. Small businesses are using this, certainly larger travel plans, We're seeing a lot of interest in our product from not only sort of solar panel providers, but anything in the green space where people are trying to put into place in their homes things that could help them from a green energy standpoint. ADUs is another big use that we're seeing for our home equity products. So people who have equity in their home and want to put an ADU on their property can help really finance that through our home equity loan, as well as any other major purchase. Car loans is another area where we see people using the product. So, one of the things about a home equity loan versus a personal loan is that a home equity loan can be up to 30 years in maturity. And so it can really stretch the payments out. So even if the interest rate is comparable, which in many cases, most cases, our interest rates are better, even if it's comparable, your payment for your customers versus some traditional products is going to be a lot lower because they're able to stretch that payment out over 30 years. So that's a real advantage versus something like an auto loan or a personal loan. So the ways to use the loan, honestly, are endless, but we want to give you just a couple of examples of the way we're seeing our customers use it today. And with that, I'm going to send it, I guess, back to Anthony to talk about how we can work with partners and help you all get access to the product.
Thanks, Jackie. So I'll cover our partnership options real quick, and then I want to talk about the value prop to both you as originators as well as the customers. On the partnership side, really, we are built to partner with lenders and other companies of all shapes and sizes. We really have 4 different options. The first, which is where we're most active today, is a private label offering, where we're working with some of the larger independent mortgage banks in the US currently and offering this product to their customers in a fully white labeled fashion, where our partners are actually originating in their name and we're purchasing the loans. Equally, setting up that sort of arrangement takes some time and commitment, both on our part and on our partner's part. So we have recently launched our own wholesale channel as well to partner with mid-size originators, where they can broker loans directly to us and access us that way. But equally, we also have some wholesale partners of ours who are private labeled and can service, any size broker originator out in the market today. And so if you reach out to myself or Pat, our contact information is in the webinar chat. We're happy to point you in the right direction and have a conversation about the product itself. The final 2 options, I know that we have a few participants that maybe work at larger institutions such as banks or credit unions. We also do have the option of partnering where we essentially offer just our technology to originate the loan. And for those non-licensed partners, there's co-marketing or other arrangements that we can come up to essentially refer loans to us to meet needs. So Kat, if you can go to the next slide. I really wanted to bring home why this really matters to customers and importantly, why it's valuable to our originators as well. So for our customers, I think, we've said this repeatedly, right? But it is a very fast process that lets customers tap their equity within days. And, we see a lot of circumstances where a customer has immediate need for cash, doesn't want to deal with a convoluted, lengthy process. And we offer a nice fixed rate product to help them tap into one of the most favorable parts of today's market, which is homes is appreciated and there's a ton of equity out there. Equally, it is a less expensive alternative to get access to cash when you have a need, be it home improvement, be it a medical expense, tax payment, whatever it might be. And so we find that this is a really, really good way to help customers meet immediate needs. And we've had a lot of success doing that as an alternative to credit cards, personal loans, and student loans. To go to the next slide, I also wanted to talk about how this is helpful for an originator. So obviously, Barry spent a long time talking about how, market conditions will get better. And even in today's market, buying a home and or refinancing in certain circumstances can make sense. We fully recognize that that is the bread and butter of most originators. What we look to develop and why we feel we have a really compelling product is that it's a very quick and easy process for an originator to introduce a customer to Figure, offer our product, and reap all the benefits of doing that in today's market. It's more engagement with a customer. It solves an immediate need a customer has. It strengthens your relationship with the customer. And more importantly, when you have or do a HELOC with a customer, you're essentially raising the average coupon that they're paying on their total lending. And this positions you very well to actually do a cash out refi for them when market conditions permit. And I'm sure that at some point the market will improve and get us to that point. The best part about this product is in all of the partnership models that we talked about, it does offer compensation. So it does help our partners get through the current market, get through the tough times, and come out well positioned to dominate when interest rates inevitably drop. Next slide. Wanted to just provide a few figures. We have over 10,000 LOs that have sent applications our way. So this isn't a new product per se that isn't widely distributed. We've had a lot of success and work with a lot of loan officers to transact with their customers. We've had over 4,000 that have actually closed the loan with us, over 100 LOs that have funded more than $1 million in volume with their customers. And, you know, in aggregate, we're close to $1 billion unlocked in equity for about 10,000 homeowners. And that is just through our partnership channel. If you actually look at overall number of customers in production, we've done about 6 billion. So there's a lot of demand for this. We see it every day, and it's, you know, a truly perfectly timed product for today's market. And close with the point that we've made 1 million times already, it is fast. On average, we close in 10 days, and, you know, oftentimes as little as 5 or 4. And honestly, if it's an investment property, as little as 1 or 2 when there's no rescission period. So reach out, happy to have a conversation with you and talk about how we could help. So one final point on the next slide. We have our friend Phil Shoemaker, who joined us today. He's been a partner of ours in the past, and we're happy to have him back on. I know that Phil, you recently joined the Loan Store as CEO. Wanted to hear a little bit from you about your vision for the company and how you think the Figure HELOC fits into that.
Awesome. Yes, I did. Excited about the new venture. I think I need to get another headshot. I think that was probably 15 years ago too. I look a lot younger then. Yeah, excited about the Loan Store. And look, I'll start with this. You know, we've had a pretty, I'll say, really a fruitful partnership with the Figure team. I have actually across a couple companies now, and I am really excited about what they're doing. And here's the way I'm thinking about it. So at the Loan Store, you know, our main focus is you know, we're a wholesale centric lender. I've operated businesses that were multi-channel in the past, and not that there's anything wrong with other channels. I just feel like, you know, if you want to be good at something, you got to focus on it. And so we're going to be heavily focused on building the best purchase-centric wholesale lender that you can build. But what I've also learned is, you know, especially given the competitive dynamic of mortgage, you know, unless you have the benefit of being really big right now, you got to go deep with people. You really got to go deep. And what I'm excited about with this product is, you know, kind of like focusing on multi-channel businesses and really kind of diffusing your focus and not being good at one thing. I think the Figure team has done a great job at really building out kind of that next gen process for HELOC, and that is all they do. And so our plan, just kind of generally, is to focus on wholesale, be the best in purchase, but diversify and go deeper with our partner base by aligning with partners that are the best in what they do. And the Figure team's you guys are the first partnership for us to roll out. I think we did it in a record, 3 or 4 weeks, and we're really excited to get going with you guys.
That's awesome. And just from your vantage point, what do you like about our HELOC product specifically versus some of the other options that are out there?
Yeah, great question. So there's a couple things. So one, I do think, man, we gotta start doing things differently in this business. We we really do. And one of the things I enjoy about working with you guys is you do think outside the box. And look, I think it's a little telling when, all of us I've been in this business almost 28 years, and I started in the tech side, and we've been talking about how technology was going to change the business, and things are going to get more efficient. Yet every year you see the cost to originate go go up. And I think what that should be telling people is the way we're going about things is just entirely wrong. And here's what I firmly believe to be the case. One, this is a relationship business. You're too many times you have people that have a tech-centric mindset or are trying to solve a technology problem come at it with the explicit goal of removing people from it. And I can tell you that's not going to happen, because the reason why those costs are going up is because us as the lenders, we're just paying for more and more technology, but we're not really removing the people. And the reason why we're not removing the people is because until you fundamentally change the way homes are bought and sold and the relationship aspect of real estate in general, it's not going to happen. And it starts with real estate agents in the field. It starts with LOs that have deep and trusted long-term relationships with those agents, where that agent knows that LO is going to be able to get that borrower in that home, because at the end of the day, that's how we all get paid, right? And so I think to get to your question and the point I'm trying to make, the thing that I'm really excited about with this product is I really feel strongly you guys are approaching it the right way. That the business needs to change, and we need to find ways to make the process easier for the borrower. But that doesn't mean we should be excluding the people. And so one of the things that we've actually done when working with the Figure team, and the first time that I rolled out this product, is we recognize that, hey, the LO plays a very important role in being able to educate the borrower on not only, even though their process is extremely simple, right? It's really, really easy to understand. This is still an intimidating thing, because you're dealing with, the person's largest asset. In most cases, the largest asset person is going to ever own in their life. And so being able to walk them through that process, I think, is a really important thing. And so using, what we just rolled out as an example, because even though the process is very tech centric, highly automated, and very easy from a borrower experience, it doesn't remove you as the LO. Okay, so that's number one. Number two, and this has been kind of the hardest thing, I think, to educate LOs on. They want to try to put this product into the traditional HELOC box, where it's taking 60 to 90 days to get that loan ultimately done. I mean, these things will fund in 3 to 5 days. And so from the efficiency standpoint, and the way that, when I talk to originators, the way I try to describe this is, hey, from a compensation standpoint, your goal isn't to do 1 or 2 of these every month. It's to do, 10 of them every month, right? That's how fast these things should fund, because that is also part of the efficiency issue that we have as an industry. We have to be able to support more loans with the people that we have. And so I feel like there's a very good balance with what you guys have done here in keeping the originator in the loop, empowering them so they can be a part of the process, making the process easier for the borrower, while also creating an incredible opportunity that I think a lot of people on this screen really need right now to make money, right, in a market that's really difficult.
That's awesome. Well, I really appreciate it. And, we wish the Loan Store well and look forward to see all the wonderful things you'll do there. Kat, let me pass it over to you. We're right on the hour, so figured you'd close it.
All right. Well, thank you everyone for joining. Thank you, Phil, Anthony, Jackie, Barry, and Mike. We appreciate your time as panelists today. If anyone has any questions from the session, please reach out to Anthony or Pat. Their emails are listed here, or hop onto our website and check it out for more information. We're happy to answer any questions after the fact. We hope that you enjoyed today's session, and we look forward to working with all of you. Thank you.
Thank you.
Thank you.
Thank you.